CFDs are contracts between the client and IBKR that deliver the return of an underlying instrument. Currently, IBKR CFDs are available on stocks, major indices, and FX pairs. CFDs can be traded in both cash and margin accounts, and there is a single CFD permission enabling trading of the three types of CFDs subject to eligibility to trade the underlying, such as FX. CFD trading is only available in certain countries. Legal residents of the US, Canada, Hong Kong, New Zealand, and Israel are prohibited from trading CFDs. Residents of Spain can trade CFDs only if they are either MiFID professionals or clients of a Spanish introducing broker or a professional financial advisor who have arrangement to provide the risk warnings required under Spanish rules to their clients. EU residents and residents of Japan, Singapore and Australia can trade CFDs issued by their local IBKR entity in their local entity universal accounts. IBKR currently offers over 8,000 share CFDs covering the principal markets in the US, Europe and Asia, as well as South Africa and Brazil. IBKR applies a direct market access model when a client places an order for a CFD. The trading system and enters a smart routed order for the hedge stock. When the hedge order is filled, the client's CFD order is filled at the same price. Any non-marketable CFD limit orders are visible on the underlying exchange, ensuring a stock-like trading experience. Since IBKR applies a DMA model and does not widen the spread like many other CFD brokers, we charge commissions on CFD trades. Market data for stock CFDs is the smart market data for the underlying stock, and clients must subscribe to the underlying market data to see real-time data. Financing is applied on the notional value of the contract, in contrast to margin stock, where financing is applied to the margin loan balance in the account. This is because the CFD margin requirement cannot be used to finance the position. Rather, it is a security deposit like the margin requirements for futures. Interest is payable by the client on long positions and receivable on short positions. Importantly, interest is applied to settled positions. If, for example, a client opens a position on Monday, interest will start accruing on Wednesday T+2. If the client then closes the position on Friday, interest will continue to accrue over the weekend and the following Monday until the trade settles on Tuesday. Most order types, including auctions, accumulate, distribute, and IB algos, are available for CFDs. CFDs participate in most corporate actions, reflecting the economic effect of the corporate action for CFD holders as if they had been holding the underlying security. This will be done through a cash adjustment, a position adjustment, delivery of a new security or CFD, or a combination of these. CFD holders, however, cannot participate in voluntary actions such as tender offers. In cases where the corporate action is complex, and we are unable to determine an accurate adjustment, the CFD position may be closed out prior to the X date. A dividend adjustment is recorded as a dividend payable or receivable when a share passes its X dividend date and is paid or charged on the pay date for the underlying. If a choice between cash and stock is offered, choice dividend, IB will reflect the dividend as a cash adjusting payment in lieu, or PIL, for long CFD position holders. Short position holders are charged a PIL. Dividends are generally applied net of withholding tax to long positions and gross to short positions. Since IBKR is the actual recipient of the dividend on its hedge stock, the withholding rate reflects the tax treaty rate between the hedging IBKR entity and the issuer country. In most cases, the applied rate is 15%. US stocks are the exception. Because of IRS Rule 871M, we are required to pass on the dividend gross to clients and withhold tax at a rate that applies to each client individually based on the client's country of residence and applicable treaties, if any. IBKR offers CFDs on 13 major stock market indices in the US, Europe and Asia, such as the S&P 500 and the DAX 30. For copyright reasons, the symbols used are stylized. For example, IB US 500 and IB DE 30. The trading unit is the index level, i.e. there is no multiplier. The size of the trade is quantity times price, making it possible for clients to trade in fractions of the size of the corresponding future. An index CFD does not directly reference the corresponding cash index. The index used to determine the value of an index CFD is a synthetic index derived from the related future. In the futures market, fair value is the equilibrium price for a futures contract. It is the price at which an investor effectively pays the appropriate rate of interest and is compensated for the dividends he forgoes by holding the future rather than the underlying shares. The fair value is determined by adjusting the cash index as follows, taking into account the time remaining to expiry. Cash index value plus interest minus dividends equals future at fair value. To determine the value of the IBKR index CFD, we reverse the process. Actual futures price minus interest plus dividends equals IBKR index CFD value. Having established the level for the synthetic index, the actual CFD quotes show spreads and ticks that reflect those of the underlying future. IB charges a commission rather than widening the spread, enabling a transparent comparison between the returns of the index CFD and the related future. A dividend is paid based on ordinary dividends for the constituents of each index, proportionate to their weight in the index. Dividends are accrued on the ex-date and settled T+2. No dividends are paid on IBDE 30, as dividends are reinvested in the index since it's a total return index. There are no corporate actions applied to index CFDs, as corporate actions are reflected as adjustment to the cash index value and flow through to the CFD via the fair value adjustment described above. Interest is calculated on the nominal value of settled positions on T+2. Index CFD market data is free, but permission is required for system reasons. A London gold or silver CFD enables you to have exposure to price movements of physical gold or silver without owning the physical metal. The IBKR London Gold and Silver CFDs reference unallocated physical gold and silver traded on the London bullion market in units of 1 troy ounce. There is no multiplier, i.e. the size of the trade is quantity times price. Unallocated means that the bullion dealer continues to hold title and the investor has a claim on the bank as an unsecured creditor. In the case of a CFD, that claim is indirect, as our clients trade a CFD issued by IBKR, who in turn has an unallocated position in the metal. Physical delivery is not possible for the CFDs. IBKR receives quote streams from approximately 10 major bullion-dealing banks in much the same way it does for cash forex. IBKR smart routes between the banks and the best available price at any given time becomes the reference price for the CFDs. IBKR does not add a spread to the bank's quotes. Interest is calculated on the nominal value of settled positions at T+2. Metals CFD market data is free, but permission is required for systems reasons. Note that the main difference between the metals CFDs and the cash commodity product is the regulatory framework. Quotes, commissions and margins are identical. IB Forex CFDs are available for the same 85 tradable currency pairs IB offers as leveraged spot FX with identical low commissions and margin rates. Quotes are the same as for spot, as are available order types and tools such as the FX Trader. Forex CFDs are rolled over, reflecting the benchmark interest rate differential of the relevant currency pair. This is in principle similar to the Tom Next rolls used by other brokers, but offers greater stability as benchmark rates generally are less volatile than swaps. The carry interest for IB Forex CFDs is based on a currency pair specific benchmark and a spread. The benchmark is the difference between the IB benchmark rates for the two currencies. It is calculated as long benchmark base currency minus benchmark quote currency to which a spread is added. As for all CFDs, interest is calculated on settled positions. Settlement is T+2, except for Russian rubles and Canadian dollars, which is T+1 settlement. A risk-based maintenance margin is applied based on 5 historical standard deviations, subject to a minimum of 10% for stock CFDs. Index CFDs are margined at the prorated requirement for the corresponding future, subject to a 5% minimum. FX CFDs have the same margin rates as cash-leveraged Forex, both maintenance margin and initial margin. Initial margins are 1.25 times maintenance margin. Stock CFDs are also subject to the same house margin requirements as the underlying stock. For example, all UK stocks have a minimum margin of 18% and all Hong Kong stocks 20% because of country risk. Concentrated stock CFD portfolios may also be assessed a concentration charge. To calculate the charge, we apply a 30% requirement to the 2 largest positions and 5% to the remaining positions. If the sum is greater than the sum of the standard margins calculated as above, the concentration charge is applied as the margin requirement for the account. In practice, any portfolio with less than 10 holdings is likely to be margined based on concentration. European regulations require that MiFID retail clients are subject to leverage limits and other protections related to their CFD trading. The provisions apply to all retail CFD clients, whether they reside in the EU or not. The leverage limits apply as initial margin, and the liquidation threshold, i.e. maintenance margin, is defined as 50% of the original initial margin paid when the position was first opened. Stocks 20% initial margin, major indices 5% initial margin, minor indices 10%. Major FX pairs 3.33% initial margin, minor pairs 5%. Importantly, we apply IB margins wherever they are higher than the regulatory minimums. The IB initial margin requirements are typically higher for most indices and FX pairs, and for stocks whenever house margins or concentration are applied. IB maintenance margins are, in practice, always applied, given the low regulatory liquidation threshold.